Hi, my name is Chris Decker. Welcome to another episode of the Mission Ready podcast. We're in Kenya today and honored to be joined by John Kriegsman. John Kriegsman is the managing director at Renew Capital, an Africa-focused venture capital firm where he leads capital advisory and market strategy from Nairobi. He previously represented the United States on the executive board of the European Bank for Reconstruction and Development and served as a U.S. Treasury attaché in Nairobi. John's background in the Navy, his education at Columbia University in finance, and just the fact that he can speak Swahili and he's based here in Kenya makes him a market leader and someone we really are interested in talking to today. So I'm excited to introduce John. And John, please tell us a little about yourself.
Sure. Well, it's a real privilege to be here, so thank you for the invitation. I'm from California, originally from Hong Kong. I was born there, and then grew up in Connecticut, California, Florida. I was thinking before this podcast about, I hope I'm only halfway through my career. And I was thinking about the places I've lived, or the conditions. I've lived in barracks in the military with a bunch of other people. I've lived in a dilapidated palace in Spain. I've lived in underground apartments in Brooklyn, basement apartments. I've lived in a pool house in Nairobi. I've lived in a beautiful apartment in London, and I've lived in a small metal box in Afghanistan for a couple years. So that's a interesting framing for the conditions of my life so far. I did my undergrad at Columbia in New York. I studied physics. I graduated in 2000, and in September of that year, I went down to Times Square, and there's a building there with a neon American flag on the side, which is a recruiting booth for, at the time, all four branches of the military. Sure. And I walked in and joined the Navy. If you want, we can get into the motivations, which are still unclear to me. But found myself quickly in Pensacola, Florida. That's where the barracks come in, and did officer candidate school there. And I served as a naval intelligence officer for 5 years. So from basically I was commissioned in 2001 through 2006. I was at Naval Intelligence School on 9/11. So you'll remember the pre-9/11 era. There was the peace dividend. There were,
Sure.
So there was no expectation that the trajectory of my life would dramatically change. And of course, that's true for millions of other people. My first duty station was in Japan, and I was stationed in Bahrain and in Spain, and primarily was engaged in, I was planning and conducting aerial reconnaissance, surveillance, intelligence collection missions in the Western Pacific, in the Indian Ocean, in Mediterranean, and in the Caribbean. Served in the Iraq War in March, April, May of 2003. So those opening phases. I got out of the Navy in 2006, and I joined a hedge fund in Connecticut. I was a high yield debt analyst. So the pejorative term for this is junk bonds, but when you're trying to market them, it's high yield. And I enjoyed that. I was there for a bit over a year into the financial crisis. So a lot of lessons learned there, but one that I think I've benefited from. I went back to Columbia for grad school, benefiting from the GI Bill, which for those who aren't familiar, was developed after the Second World War, and I think was a real key driver of the success of that greatest generation as they came back from Europe and from Asia and becoming really productive members of society. So I benefited from that. My aim was to combine that national security background that I had from the Navy and that less significant financial background that I had from this hedge fund, and try to combine the two. So I studied finance and Swahili on the side. There was a language requirement. And so I thought, I'm going to pick some language that I have no background in rather than resurrect middle school French. So I studied finance and Swahili, hoping to focus on sub-Saharan Africa because I developed an interest in it. after I graduated in 2012, I joined the Treasury Department because it seemed like the perfect way to combine finance and national security. People probably don't think about the Treasury that often, the average citizen in the U.S. and what the Treasury does is it's one of the focal points of financial statecraft in the United States. And I thought that would be a really interesting place to work. So I moved from New York to Washington. But very quickly, an opportunity arose in Afghanistan itself to serve as the Treasury attaché. And I had read about a guy who was at that time a Columbia law professor who'd been the Treasury attaché in Baghdad a couple years before, and I thought that sounded like a really interesting role. So I had my eye on it when I got to Washington, but I couldn't have envisioned that I would actually be out within 8 months. So I ended up in Kabul. I was there for 2 years. I just kept extending because it was a really great experience from 2012 to 2014. From there, I moved to Islamabad, and it was really interesting to see the same war on two sides of the border. And so, yeah, if I spent 3 years, I mean, as we called it, AFPAC. I mean, I was there for 3 years straight, basically. Returned to Washington, saw a position at the European Bank for Reconstruction and Development, which is a development bank based in London that I found really appealing, both the mission and the opportunity to serve abroad again. So I was lucky enough to go there, and I was there for 3 years through COVID, which kind of dragged it out. It kind of froze the mobility of diplomats serving abroad. And then finally, an opportunity in Kenya arose. There hadn't been a Treasury person within the embassy here, and the Treasury and the State Department created the position. And of course, I applied for it. I was not shy in mentioning I'd studied Swahili for 2 years. And so I was lucky enough to get it. And we can get more into what that role was like, but that's the long answer to your short question.
What a time, right? Because you got OPIC transferring to DFC. And
Yeah.
So what was your observation when you were there doing Treasury work at Kenya?
Sure. Well, the role was similar to the roles I had both in Afghanistan and Pakistan. There are two lenses for a attaché. There's the carrot lens and there's the stick lens. And so it's the U.S. Treasury that represents the United States at the IMF, the International Monetary Fund, at the World Bank, at the African Development Bank, and at the European Bank for Reconstruction and Development, where I had been previously. So those are the carrots that we can provide. We vote on projects, we help shape policies that those banks follow, and so that's the route we have to help countries manage crises, to develop, et cetera. And of course, U.S. aid is the bilateral, or was the U.S. bilateral development arm.
Yes.
that worked in collaboration with those multilateral development banks. So that's the carrot side. The stick side is that it's the Treasury that also does that focuses on money laundering, on terrorist financing, on proliferation financing, that works with the Financial Action Task Force. OFAC is part of the Treasury Department. And so that's the stick component. And so you can imagine that in Afghanistan, there was a significant role for both of those lenses. That was true in Pakistan, and it was equally true here in Kenya.
But when you were in Kenya, was it more about investments, more about that type of financing, or?
So we had an ambassador here who had come from the tech sector, come from the business sector, and she was very focused on deepening the relationship between the U.S. and Kenya, but also all of Africa from a investment in business and commerce and financial perspective. And so I and others from the embassy worked with her to craft an approach that would foster that deepening. And you mentioned the DFC. The U.S. has a lot of tools that
Right.
that we use. So, like the Treasury is one component of that. But we have a Department of Commerce, we have Ag, we have the State Department itself. We have, at the time we had USAID, that's being, components of that are being resurrected within the State Department. So some of those tools have been changed. But we had a variety of different ways. And I think within our embassy, I mean, the nice thing about working together in a single building, sitting in a single room, is you can really match those skills together and try to be as effective and efficient. The ambassador, something that we might talk about later, but she identified some gaps in the enabling environment here, the business environment. And so we approached the government of Kenya with a couple items we thought that they should take a look at, some with respect to tax, some with respect to their approach to the tech sector. My contribution was trying to encourage them to look at some money laundering and terrorist financing deficiencies that also can be they can lead to inhibitions by international banks to want to operate in any given jurisdiction. And we presented these to the government of Kenya and urged them to launch a series of reforms. And the flip side to that was the ambassador said, "I will." If you do undertake these, I will lead a series of roadshows in the United States to give Kenya and all of Africa, by extension, an opportunity to present the investment case, because the ambassador felt like it was strong, felt like we were contributing to the improvement of those. Of that environment, and wanted to give that opportunity to Kenya to showcase those changes and the underlying opportunity. So that was a multi-year effort, culminating in a state visit by President Ruto to the United States.
Yes.
And from my perspective, it was really successful. I've talked to people investors who still remember it and actually see that there's been a positive income from that, positive outcome.
But John, you left public service after that, right?
I did leave public service.
So what
Why?
transitioned you?
Yeah. So under any circumstance, I would have returned to the United States in July of last year, just given the cycle of diplomats posted abroad. And I loved the work of the Treasury. The teams we have there are incredible. But I also felt like I knew the exact desk I would return to, and my preference, as my introduction probably indicated, is not to be in Washington. And I had there were personal reasons as well. I have a family here, and who are anchored in the community and school, etc. And so I wanted to provide stability for them as well. And I found an opportunity with a investment firm focused on Africa. It felt like a shame to have spent 2 years studying Swahili, to have lived here for 3 years, and then to return to the United States, perhaps never to use it again. So
clearly, you knew too much. I think that's why.
Maybe
it was time to return.
Yeah, maybe. So I was happy to have really lucky to have the chance to stay and use some of the skills that I developed in a new manner, but also to learn many new things. I mean, I'm still on a learning curve myself, and so it's nice to be challenged on a daily basis.
How's it shaping your thinking? All this experience, military, public service, now you're in private.
Yeah, I will probably never have the level of responsibility that I had as a 25-year-old. So in 2003. I was picking routes for surveillance planes to fly into an integrated air defense system. It was degraded, to be clear, but still there was a lot of metal in the air. And my aim at the time was to make sure our planes weren't hit. And I was flying on some of those missions, so there was a vested interest in making sure they were safe. I remember one of the COs in our squadrons at the time he was, I think, emotionally prepared to lose an aircraft. And that's with 15 to 20 people inside. and thankfully we didn't. Um, but I don't expect to have that level of responsibility again. But that put things in perspective. That the worst thing that can happen is you lose money in an investment,
Yeah.
or damage your reputation or other things. But you're not going to lose a plane. So I think that's been a helpful framing for me in terms of taking risks, because there's not going to be a bigger risk than the ones I've taken.
Yeah.
From a government perspective, I think I learned a lot from the experience I had here in Kenya with those roadshows. I have to confess that I hadn't, in my previous working life, spent a lot of time thinking about Silicon Valley, thinking about venture, thinking about technology. I mean, I've certainly benefited from it, but I hadn't really thought much about that creative process. But sitting alongside our ambassador, whose DNA is from that world, was really instructive to me. I think there are still a number of really interesting investment verticals, as they call them, in the United States. I think defense tech is really interesting. It goes without saying that AI, despite being a double-edged sword in many respects, is incredibly interesting.
We hear they're doing mission planning too now. So
Yes, exactly. Right.
little
Right.
better.
So there's an integration. I mean, even, they're not totally separate columns. And then finally, energy is also interesting. I mean, you've seen a lot of investment into modular nuclear reactors, et cetera. So my old physics brain gets excited when I hear these things. In Africa, well, I would add that in the US, you also have a lot of socially pernicious investment. And I think we've started to see 20 years later the impact that social media has, not just on grown-ups. I mean, I was lucky enough to grow up in a time when phones didn't exist. I mean, I developed as a person before, I could learn to be jealous of the rest of humanity.
Yes.
And I think, I have an 8-year-old now, and he is going to grow up in this environment. And I think every parent is thinking, how do you navigate this when it's potentially, down the road, we might look back on social media like we do on cigarettes. So there's a lot of money to be made in social media, and I think a lot of people got into it with very positive rationales. But I think you've seen some negatives too. And then you've also seen in the U.S. a lot of investment into, say, consumer apps. And like Uber's one that's been transformative.
Sure.
I think it's created all kinds of job opportunities and efficiencies. But I also think, there's probably some app out there that's going to help me schedule a massage faster. And the social utility of that is, it's asymptotic. In Africa, it's a very different picture. I think
okay.
there are some challenges here that have been solved in the United States or in Europe or in Asia that are unsolved here. And I think there's a real opportunity for venture capital, for technology to help overcome those challenges.
So where are the focuses here that are different?
Yeah. I mean, one of the really interesting things about Africa, and it's a story that's famous if you live in Africa. If you don't, it might not be something that you're that familiar with. But Africa is famous for leapfrog technologies. And what I mean is that you never really had a landline phone generation here. So in the United States, from the 50s until, the 1990s, you had landlines, and the only innovation was maybe a cordless phone until mobile technology came. And of course, now no one has most of Africa skipped that entire landline generation. And so now you have mobile technology that's prevalent. Africa's leading when it comes to mobile money. So M-Pesa is what put Kenya on the map as a technology hub. You go to the U.S. and it looks backwards in some respects. Cash transactions, it's, of course people use credit cards, but mobile money is not as prevalent as it is here. And here it's just been transformative. I was talking with there were some investment bankers visiting last night. I had dinner with them. And I said, do you ever see battery-powered motorcycles in London? And the answer was no. You have bicycles that have a battery
Yes.
pack, but you don't have full-on motorcycles that have a removable battery. And I'd say 1 in every 10 motorcycles here in Kenya, if you look at it carefully, you see a metal box. You don't see an internal combustion engine.
Yeah.
And I think that's another opportunity where Africa just leapfrogs and is ahead of where quote unquote developed economies are. And I think you'll see more of that. And then the third sector I see is in finance. Certainly in the US and Europe, you're starting to see the rise of what are called neobanks, so banks that don't have a brick and mortar presence.
Yes.
And I think that, again, in Africa, that's going to be a leapfrog opportunity. And it's something that, we're involved in all three of those sectors that I mentioned, but I think it's that third. It's the one that we're currently focusing on, and I think has a transformative potential.
When you talk about markets, though, it's not one market, right? You're looking at different areas.
That's fair.
How does that go?
Yeah, it's fair. So there are 54 different countries if you look at all of Africa. It's a 15 or 20% of the world's population. I think about 4 or 5% of the world's GDP. The IMF projects that that Africa will grow faster at a faster rate than Asia starting this year or next.
Oh, really?
That's a really interesting fact.
That is.
But you're right in that it's there's that almost hackneyed phrase that Africa is not a country. And if you live here, you know that. But the amount of mental space that Africa holds outside of Africa is relatively small, I think.
Yeah.
Something that our ambassador used to say when she was here, that when she was the head of a major multinational in the U.S., Africa occupied maybe 1% of her focus. And when she arrived here, she realized what a mistake that was. But to answer your question, the investment that we're making is predicated on a significant observation, which is that credit to the private sector in Africa is quite low. And by what I mean by credit to the private sector is the outstanding stock of loans from banks and non-bank financial institutions to private sector actors in any country. And for a sense of scale, and this is World Bank data, the US is at around 200% of GDP. That's probably beyond the point of over-financialization.
Yeah.
Kenya is at 30%.
Oh, really?
And the African continent is at 30%. And there are a number of studies to show that up until around 100% of GDP, additional credit to the private sector is a real driver of economic growth. And so that number that I mentioned before about Africa surpassing Asia, that's despite not having the levels of credit that Asia has experienced. Asia's at around 170%. So within Africa, that figure is 30% of GDP, but with significant diversity across African countries. So I mentioned Kenya, happens to be at that continental average. Unsurprisingly, South Africa is at about 90%. It's a more developed economy. It's got a deep banking sector, et cetera. Similarly, Morocco is at around 80%. Oh. But some countries are in the single digits. And for some countries, there's no data. So there's a huge diversity just in our underlying observation, which is driving our investment approach. But you also have different licensing regimes.
Yes.
You're going to have, from the banking side, you're going to have different, from the banking side, you're going to have different capital requirements, different regulations. And then you're also going to have different consumer preferences. You know, like a Ugandan is not the same as a Kenyan, and what works in Kenya might not work in Uganda, not just because of licensing challenges, but because people are different. And that's just two neighboring countries. So imagine how different it is from an English-speaking country like Kenya to a Francophone country like Senegal, for example. Yeah. So those are three or four different categories of challenge that make it harder for a company in, say, Kenya to scale across border than it would be for a company in Indiana to scale to Ohio.
So, but how does the capital allocation work in these types of situations here? Is it different? It's different, right?
Well, you have to balance a different type of risk. You don't want to be over allocated to a single country. I mean, Renew Capital is a Pan-Africa fund. So there are some funds that are going to be solely focused on South Africa or on Nigeria or Egypt. And of course, their exposure is then going to be 100%. But for our purposes, we want to be more broadly diversified. So we have an internal cap on how much we can invest in a single country or into a single sector. And that's just because certain sectors can have downturns, certain countries can face challenges, et cetera. So you want to be quite diligent about how you make those allocations. And that goes beyond how you actually pick individual companies. This is more about the risk management.
But even if you allocate the funds, they still need working capital to grow. I mean, so you're committed to long term. So once you're in, you're in.
That is right. Alternative investments tend to have longer time horizons. So if you're invested in a mutual fund, or I'm speaking from the American perspective, in a mutual fund or an exchange traded fund like an ETF, if you're unhappy with it, you're able to get out in the case of an ETF instantly, in the case of a mutual fund by the end of the day. If you're invested in a venture capital fund, in a private credit fund, in a private equity fund, you're locked in for potentially a 10-year period. There are secondary markets, but with huge discounts to the face value of that investment. So there are escape routes, but it's more difficult. And the reason for that is that on the investment side, we ourselves are committed for a long period of time into those startups that we've invested in part for the same reason. It's not it's a private sale. I mean, you're invested it's not a listed company. You have a private arrangement effectively with that startup, along with other investors. Maybe if you decide you need to exit that position, maybe you can find a buyer from one of the other equity holders or from another potential holder, but it's not remotely as liquid as you would find as an investor in the S&P 500. So these are long-term commitments. And an innovation that we want to bring to this is, you mentioned working capital. That is a challenge. That 30% figure that I indicated before is an indication that the traditional banking sector isn't really delivering for a large proportion of the private sector within Africa. They can deliver for they can buy government debt. They will lend to state-owned enterprises. Large corporates are going to have an easier time finding credit. But if you're a medium-sized enterprise or below, the collateral requirements are very hard. The timelines are very long. So it's a real challenge. And what we aim to do is to invest equity in these startups, but then to start providing debt, at first cautiously and then increasingly so, to give them the financial wherewithal that they need to run their businesses and also to finance their own customers, right? Because the end customer is also going to face a financing challenge. And so we want to make sure that they are able to afford the goods or services that our startups, that our portfolio companies are selling. And so we want to provide the debt that they need in order to
So this is Renew Capital you're talking about.
This is Renew Capital.
Is there other aspects of Renew Capital that you think about that's unique here in this market?
I would say that's one of the primary innovations is that we mix equity and debt together. That's a fairly unique proposition, but we think for a lot of companies that's the right recipe. The other innovation that we're bringing helps to tackle that fragmentation challenge that I mentioned before. If you are wildly successful in Kenya, and you want to expand into Uganda, there are a number of obstacles there. We've already touched on a few of them, but we aim to build a licensing layer and a banking layer that will allow a company to expand from one economy to another, and not face at least all of the hurdles that they would face without that layer backing them.
So you really have a government affairs effort going on? Is that what you're talking about?
I think any company operating in any setting has to be cognizant of a government. Of the jurisdiction in which they're operating, and so we don't have a specific government affairs function. But I'd say anything we do, any investment we make, any strategic direction we take, there's a government component that's part of the thinking.
So Renew Capital, you just had one round of fundraising that you're deploying that capital, or do you have continuous raising that's going on? How does that work?
Yeah, it's a good question. So we have a number of funds outstanding that have made investments in about 50 companies across the continent in about 10 different countries. We are fundraising for a new fund. Because we think that opportunity that I outlined before is just enormous. If that stock of private sector capital to the private sector moved from 30 to 100, which again is where you start to see the benefits start to flatten out, I think that's about a $2 trillion gap, and some of that will have to be filled by the banking sector. There's room for many other actors to contribute to that closing, and we want to play our part in doing it. And so for us, we feel like 65 or 100 million is the right volume for us. And so we are in the process of fundraising. There are a couple different categories of capital provider. The one is development finance institutions or the international financial institutions. They are easy to find because there aren't that many of them. They are fairly easy to talk to, and they're fairly transparent about what they're looking for. But they're also very rigorous. They have boards that they need to report to, and those timelines can be lengthy. So that's one end of the spectrum. And the other end are high net worth individuals and family offices who are much harder to find. There's not a directory. But they can be faster moving and they can be more flexible. I don't want to say they're less rigorous, but they just have different ambitions from a large development bank with many stakeholders. And then you have in the middle, you've got foundations, philanthropies, et cetera, with different different factors that drive the approach that you would take. And so the role that we play as a fund is basically you have huge pools of capital in Africa, but also in the United States and Europe and in Asia. They're looking for a return. There are incredible opportunities in Africa. Again, our slice is in that startup venture sector, but there are others. And our aim is to basically be the vehicle through which large pools of capital looking for a diversified return can be married to those opportunities. And that's within the ecosystem.
Do you guys have competition? Because I don't really hear anybody doing this.
There is competition, yeah, for sure. There are a number of very successful venture funds on the continent. There are private equity funds that are, and just for your listeners who might not be familiar, private equity tends to invest in larger, more traditional businesses where the dispersion of outcomes is narrower. Yeah. In venture, you're looking at really early stage or growth companies where the potential for failure is higher than what a private equity investor would accept. But the potential for takeoff for success is also going to be higher. So there are a number of companies of funds that are dedicated to Africa. You also have a number of funds that are maybe pan EM, pan emerging market, which would include sub-Saharan Africa.
Yeah.
But I think your observation is fair. I mentioned before that Africa is about 20%, 15 to 20% of the world's population, 3, 4, 5% of GDP, depending on whether you count North Africa. But it represents about, I think, 0.5% of venture capital penetration, or of the global market cap of venture capital. So obviously, the United States absorbs a lot of venture capital for reasons that are understandable. But we see, like, while there is competition, we think that there's plenty of room. And that under-penetration, I think, represents an opportunity.
Well, so you talked about the 3 current focus areas you have. What about the next 10 years? Do you think that'll change, or just expands your 3 areas for the next fund?
Yeah. Well, our focus is going to be on that third one. So while we do have exposure to e-mobility and to mobile money, our focus is going to be on fintech, for lack of a better term. But I would add that our view is that basically for any startup to succeed in Africa, it's going to have a fintech component embedded within it. An example I'll give you is, if you are on Amazon in the United States, if you're buying a $25 book, most people are able to afford that on an upfront basis. But if you're looking at some kitchen appliance, it might be, say, $200, and you'll have the opportunity to pay over 3 months.
Yeah.
That's embedded finance, and it's seamless, right? So when you're on Amazon, there's something you can click and you can pay over 3 months, and it pulls from your credit card over 3 months, and the transaction is no more complicated than just paying up front, but it changes the affordability curve in a sense. And for you as a consumer, if you had to pay that $200 up front, that might have been a deterrence. But if you're able to spread it, then Amazon has succeeded in bringing you in as a customer. And so our view is that given the fact that the GDP per capita on the continent is certainly lower than in the US and Europe and other parts of the world, that question of affordability is front and center. And I'm not talking so much about individuals, but really more for businesses.
Yeah.
But if they're facing a $10,000 purchase of a HR software, if they can spread that over 6 months, that might be the difference between a startup earning that customer as a customer, or losing them to a competitor.
Yeah.
So our view is that embedded finance is really the vehicle that or the technology that companies will increasingly rely on to succeed in many African
You know what surprises
markets.
me, though? I don't hear you talk much about infrastructure investments, but when you go to all the big national funds and the international, they're all looking at long-term big investment. China, of course.
Sure.
What's your thoughts on that from your perspective?
Well, I think these are complementary efforts. We certainly benefit from. I, as someone who lives in Kenya, but our company, our fund, our firm benefits from the fact that there are investments into infrastructure, but at the same time, infrastructure without the growth of the businesses who use it is not profitable. And so our focus is really on trying to build those businesses that ultimately will be the users of that infrastructure. But we're a specialist in what we are, and you have other funds that are specialists when it comes to, say, physical infrastructure, and one doesn't, each requires the other to succeed.
You were talking about sticky versus not sticky. Is that part of this too?
Well, what I was mentioning, and this is before we started to record, is that there are, different types of capital flows have different kind of a different quality to it. And if you're investing in, say, listed equity on the South African in the Johannesburg Stock Exchange or in the Nairobi Securities Exchange, and you change your mind, you can get out almost immediately and take your money back to the United States or to London. If you are invested in bonds that have been issued by Kenya or by Angola or by Cote d'Ivoire, and you change your mind about the prospects of that country or its ability to repay, within a reasonable amount of time, a couple days, you can get out of that position. And so that's a risky type of capital. And if the global sentiment changes against that country or the entire continent, then the ability to refinance those positions is going to be a real challenge. So that's, you can call it, perhaps fast money. Other types of investment, and I would include infrastructure. I would include what we do on the venture side, and I would include direct investments into, say, factories, which is often categorized as foreign direct investment. That's stickier money, meaning that it's hard to pull back, and countries tend to benefit, I think, more from that kind of investment. I mean, there's a role for each of these. I don't want to be dismissive of listed equities and of Eurobonds, but I think there are ancillary benefits to the stickier types of investment because they lead to skills transfer, they lead to job creation, and if you're investing in a highway project, that's a multi-year project.
Absolutely.
You are teaching people how to be project managers, how to be welders, how to, in our case, we're investing in companies that in turn hire people who in turn hire people. If you're investing in a factory, I'll think of just the case of Kenya. You are teaching people how to how to make apparel. You are hiring there are a number of factories here that have very, I think, very responsible social practices where they have a crèche, right, where they have a childcare facility. So now you're hiring a nurse and you're hiring, a child professional. And so you can see that these knock-on effects of employment and skills transfer, et cetera. And again, that money can eventually leave the country, but it's a decade-long commitment.
Yeah, absolutely.
So that's the distinction I was drawing before.
I see.
Yeah.
Well, so when you're raising capital, what would you like these investors to understand? Because obviously they come here, they don't really understand the market. So how do you do that?
Yeah. I think there's been a long-standing debate about whether Africa faces an Africa penalty. I have mixed feelings about it. This is a roundabout way of answering your question. There is a debate about whether the credit rating agencies accurately rate African countries. So, for example, the U.S., Canada, many European countries have a AAA rating from Moody's or from S&P or from Fitch. African countries tend to be lower on that scale, and there's been a long-standing debate about whether the standards are equally applied. I have mixed feelings about that. But where you do see a real Africa penalty is when things go terribly wrong in the United States. So when a crypto exchange goes down the drain overnight, people move on. It doesn't lead to a black eye eternally in the United States.
Yeah.
And for Africa, I think Africa doesn't get as many chances. So there was a major private equity fund that had engaged in some fraud. It was not an Africa-focused fund. It was an EM, emerging market fund, more broadly. But that one failure made it difficult, cast a shadow for a number of years for funds in general to raise money focused on emerging markets and frontier markets. And one other example, there was a really, it still exists, a really interesting company from West Africa listed in New York. That's a huge triumph. But the performance of that stock has been middling. and you haven't seen listings since then. That's been like half a decade.
Oh, wow.
So, there are, when things don't go well, you get a real headwind. And, we mentioned, we discussed before the fact that Africa isn't a country, right? I remember the Kenyan president was observing, maybe complaining about the fact that there was political dislocation in Chad, and Kenyan bond prices fell, and that's because traders or investors in Europe saw some bad Africa headline and thought, oh, we need to scale back our broader exposure. But we're here in Kenya. You know that Chad is like a desert away. I don't know how many kilometers. It's probably 5,000 kilometers from here. And what happens in Chad doesn't really have a direct impact on what happens in Kenya. So to answer your question, an investor in the U.S., there's an education issue. Most investors face a home bias. If you're a French investor, you're probably going to invest in French companies because you know them. You are familiar. Maybe you'll move to Spanish or to German companies or invest in Europe in aggregate. Maybe the U.S. just because we have a relatively high profile. We're pretty familiar. We're a safe environment. If you're in the U.S. And you're looking for exposure outside of the U.S., you're going to look at Europe. You're going to look at Japan. You're going to look at Canada. If you look at EM in general, you're going to look at Brazil, you're going to look at China. Getting people familiar with Africa and being straightforward about the strengths and weaknesses is something that that we do, but that needs to be done. And I think when family members or others come to Africa for the first time, it isn't the safari. It's an eye-opening experience that, this is, it's a great place. I feel safe. You can live your life just like you do anywhere else. Every country in the world now, I mean, we haven't really talked about geopolitics, but amid the fragmentation we've seen, amid drastic policy changes from all kinds of different directions, in many respects, Africa looks stable. And it's the other countries that are making waves.
Yes, of course. A lot of the listeners are really interested in large institutional banks and investments.
Sure.
But we don't really understand how they interplay with, say, a private investment firm like yourself.
Mm-hmm.
Is there a relationship between, say, a DFC or World Bank and what you guys do?
Yeah. Yeah, so I'll have to declare an interest here, which is that we are in discussions with many of those development finance institutions. So I'll just lay that on the table. And I've also worked at one. So I was on the board of the EBRD. Look, American taxpayers have contributed through their hard work our shareholding in those institutions. So in the case of the EBRD, we're a 10% shareholder. In the case of the World Bank, I think it's about 16%. In the case of the DFC, it's 100%. And I think when I was on the board of the DFC, of the EBRD in London, we had certain things that we were not that we were basically directed not to support because they violated certain internal rules that we had about environmental disclosures or other things. But beyond that, we had a certain latitude when it came to supporting or not supporting projects, and we supported most of them, just to be clear. But I would often think. Before we started recording, we talked about our respective families' immigration into the United States 150 years ago. And I have family that live in central Illinois. They're hardworking people. They pay taxes. Could I explain to them why I supported an investment in a highway outside of Dushanbe in Tajikistan?
Yeah.
We probably did support that one. I don't remember the details.
Probably did.
And then later, I went on a visit to Dushanbe, and there was a highway project. I don't
Yes.
remember if it was the one we invested in.
Yes.
And sitting alongside that highway project was a Caterpillar tractor made in Illinois. And I thought, and we haven't talked about the Belt and Road Initiative yet. If that had been a Chinese finance project, there is no chance that American equipment and suppliers, et cetera, would have been incorporated into that overall package. But the fact that the EBRD was a financier into that project certainly didn't guarantee that an American company would be a participant,
Yeah.
but at least created the opportunity, right? And so when I talk to my family, and if they ask me questions about this, I can present that case and say, look, this isn't going to be the case in every circumstance, but there is going to be investment to be done around the world, and if you want American companies to benefit from this, then you benefit from the shareholding that we have in these institutions, and that's not just true for the United States. That's true for Brazil.
Sure.
It's true for France. It's true for Japan, and in the case of the DFC, I again have to declare an interest that that we've had conversations with them. But even before I had joined Renew Capital, I had expressed admiration and support for the direction
Sure.
that they're taking. I think at their best, not just the DFC, but these organizations, these DFIs in general, you have risk-averse capital. You have a lot of it in the U.S. and in Europe. You have a lot of use for that capital in traditionally more difficult parts of the world, or just remote parts of the world. And at their best, I think these institutions can serve as a wedge, and as a provider of political support.
Yes.
And so if these institutions were to say, we see a real opportunity in this corridor project in a certain country, need not be Africa, and we want to harness private sector investors here, those private sector investors are more likely to take comfort from the fact that perhaps the DFC is leading, maybe they're
Yes,
taking a first
absolutely.
loss position. And then the other aspect, and this is it's a bit fuzzier, is the fact that let's say the project goes off the rails and this happens, the embassy is going to have your back because U.S. government money is in the project. And so when you need to go to the government and say,
Yes.
there's a roadblock, there's some kind of obstacle, there's some regulation that doesn't make sense, not only is private sector capital tied up here, but the U.S. government is tied up here. Can we have a conversation? And this is a role that the World Bank plays. This is a role that the IFC, that the EBRD can play, where it can, in a way that's sometimes hard to quantify, it can lower the risk profile for a potentially risk-averse institutional investor.
I see. So, but let me, because I don't understand this space. In the old days, DFIs would do direct investments into projects or things. Now, are they going through private investment funds like you as well?
So they do both.
Did they always do that?
I would say at least since about the 1980s. I might, when I go home, I will probably Google to see if I got that right.
Okay.
But it's been some time that the IFC in particular, which is the private sector arm of the World Bank, has invested directly into funds.
Oh, wow.
Again, with a development ambition in mind. So that is certainly something which has been 50 years in the making. And then looking more at the World Bank and the African Development Bank, traditionally they are doing sovereign type investments, right?
Yes.
But if they can crowd in the private sector, in a sense, they are leveraging their balance sheets, right? I mean, and this is an increasing focus. I mean, as a shareholder or as a member of the board of the EBRD, we were often pushing for as much mobilization as possible. And what I mean is that, like these banks are big, but they're not enormous. I mean, the World Bank is large. EBRD is, say, medium size. You want to maximize the impact of the capital that's been invested by taxpayers. And so if you're able to identify a project and sure, maybe you could finance the entire thing, but it'd be great if you could finance a quarter of the thing, bring in private sector money, and then you actually have 75% remaining to do some other project. And again, you can bring the private sector in there. So you've really amplified the impact because, again, at their best, it's a wedge. It's not the entire package.
So, but in this case, they're sharing the stakes.
Sure.
But do they ever actually just directly invest into private funds
That does
and
happen.
let them deploy and why would that happen? And is that a new development?
Well, as a general matter, these DFIs won't want to take more than 20 or 25% stake in a single fund for the same reasons that I outlined before on those, say, direct investment projects. In fact, no one really wants to be the sole investor in a fund. You want others to be to share that risk with you. But again, it would almost defeat the purpose for one of these DFIs to be the sole investor because they would have lost the opportunity to amplify their impact. And what can happen is that, say, if a major DFI were to say, we're going to take a 20% stake in this fund, other investors will see that and know that the IFC, if it's the IFC, has done the rigorous work, due diligence, et cetera. And of course, that other investor will do its own homework on the quality of the fund and the team and the strategy, et cetera. But the fact that a major DFI has invested will open doors. Yeah, it's a signaling effect.
Maybe you could go back and just talk about your observations when OPEC evolved to DFC, and then how did all that change? You were there when it was all going on, right?
Well, I was an observer. I mean, I was certainly not part of it.
Yeah.
But I was a admirer of the Build Act, which is what led to that transformation. I mean, OPEC I had worked with before. I helped unlock some challenges they faced in Pakistan, for example. So I was somewhat familiar with how they operated, but they were somewhat restricted in the tools they used, and they were also somewhat restricted in the counterparties they could engage in. And so what I admired about the creation of the DFC is that it widened the tools they could use. So specifically, that allowed them to use equity, which, as I understand it, OPIC was not able to do. That was number one. And then number two, they could be a bit more broad in their partnerships, meaning that the U.S. nexus was loosened a bit, which allowed them to be a bit more strategic. And so, for example, if the DFC were looking at a say highway project in some country and the only implementer was a French company, if it were OPIC, they might not have been able to provide that support. With the DFC, they can be a bit more thoughtful and deliberate in how they partner, and I think that's to the benefit of the U.S. from a strategic perspective. And then the other thing which I haven't mentioned is that I think that the envelope that OPIC faced was $29 billion. When the Build Act was created, that became 60, and then as of December through the NDAA, the National Defense Authorization Act, that number was increased to a bit over 200.
And why do you see that happening? What's your opinion on that?
Well, I'm a supporter of it.
Yes.
I think the reason for it is, I mean, I'll rewind a little bit. I was in Pakistan when the China-Pakistan Economic Corridor was unveiled. And that was one of the 6 main avenues of the Belt and Road Initiative. At the time, it was One Belt, One Road. That name changed slightly. And I was, I spent a lot of time trying to understand what the projects they were investing in, what the timelines were going to be, what the financial impacts were going to be on Pakistan, because it's not necessarily all positive when the repayments start, right? And if you accept too much capital at once, you might face a problem down the road. So really trying to understand that, and that and that led to a broader interest in the Belt and Road Initiative as a whole. And I think there's been, certainly in the United States, a lot of negative press about it. I think I have a more balanced view. In many respects, I admire it and wish that we had thought of it. Our structures are different. The relative advantages that we have and that China has are also different. So if we had done it, we would have done it in a very different way. But I admired the strategic initiative that they took, and also the commercially led angle that they took. So with that said, when I saw the role of OPIC shift into the DFC, and I saw the size of the DFC change, I felt like, okay, this is our response in an American way as opposed to a Chinese way. But I admire the fact that we are looking at some of the strategic vulnerabilities that we have, and using the tools that we have as efficiently as possible to bring in the private sector to address some of those strategic deficiencies.
Could you contrast between, say, our current investment strategy, DFC, and Chinese investment strategy, and how they differ and
Sure.
are the same?
So in the U.S., you can't go to an American company and order them around. You can tell them what not to do sometimes, but generally you can't tell them what to do. And I will, draw on my old military experience. But there's a notion of a commander's intent, and what that means is that if you're in the field and your communications go down and you have to operate autonomously, you know what the overall objective is, you know the direction of travel, so that when you can reconnect with your broader team, hopefully you are in alignment with those goals. And so the best orders are written with a commander's intent, so that you're not lost
Correct.
in the details.
Yes.
Right. And I think China has been skillful in creating a commander's intent, not only for the enterprises that it actually controls, because they might be state-owned enterprises, but even for private sector actors who know the direction of travel, and might take comfort from the fact that the Chinese state will have their back if they are operating in accordance with that direction. I think that's something for us to learn from. I think the DFC has contributed very positively to that. I think the public statements that they've made
Yes.
Have made it clear what it is that they are looking for. And I think if you were a private sector, either operator or investor from the United States, and you pay attention to what the president is saying, what officials from the DFC are saying, then you know the direction of travel. And so I think that's been a helpful guidepost. So again, like we're doing this with American characteristics. The BRI is going to be run with Chinese characteristics. We would probably argue on the American side that we're going to do this in a more enduring and responsible manner. But as I said at the outset, I think it's right to learn from your competitor, and I think that you're seeing that we are doing that.
Do you think there's differences in the cost of capital, how the Chinese deploy their capital versus, say, through DFC?
I mean, the pricing can be very opaque, to be honest. So that's probably not. I'm probably not very qualified to answer that. Yeah, I'm gonna pass on that
And
one.
then,
Yeah.
how they execute those investments relative to us. For example, you see a lot of COEs, Chinese enterprises owned by the Chinese government executing their large projects.
I see what you're saying.
And then on our side, it's always private interests.
Yep.
So is there differences in how those financing is done?
Yeah. I remember looking at a road project in Kenya, and it was a very straightforward project, not incredibly sophisticated. And there were 20 bidders, and 19 of them were Chinese, and one was Portuguese, I think, or Greek. But there were no American bidders in this project. I think you can argue that a long history of Chinese subsidies, either directly into state-owned enterprises or into private sector actors, has given them a global footprint that they then benefit from. So this was a project actually from a development finance institution, but it was interesting to me. On the one hand, it's difficult for the U.S. to complain that say American contracting companies are not as active in Africa when they're not bidding for projects. But part of the reason they're not bidding for projects is they didn't have the history of subsidies that got them on the ground in the first place.
Yes, that's what I'm seeing.
Right. So that's a very hard argument, I think. That's a complicated argument to articulate, and it's hard to quantify. But there are many instances, and you would know this better than me, where the number of American and this is in part driven by, in a way, it's a great thing. I mean, like the U.S. is such a huge and successful economy that you can be a successful American company and never leave the borders of the United States. That's not something to complain about.
Yes.
But what it does mean is that if your aim is to be competitive overseas, you're going to be competing against Chinese, but also other companies that have been there for a long time, and that have benefited from a history of direct or indirect state support that gave them that foothold.
Yeah. So do you think we're discussing perhaps the next evolution? We talked about OPEC to DFC.
Mm-hmm.
Maybe the next evolution is even a larger role in the execution of these large projects that the U.S. is investing in the future.
I'd love it. I mean, several years ago when I was part of the embassy, we invited, President Biden invited President Ruto on a state visit to the United States. And the U.S. government can operate in funny ways. One of them is that you make your big announcement and then you come up with all of the supporting deliverables that make the announcement make sense, as opposed to working from the ground up. You often work from the announcement down. Oh. And so the invitation was extended, and then there was a scramble among many different agencies to come up with the actual quote deliverables. This is a very government term that hopefully your viewers have never been exposed to, but you come up with these deliverables that that kind of pad the entire visit. So I was part of that process, and I had been a big admirer of the Lobito corridor, for example. And I'm an admirer of that for a number of reasons. For those who aren't familiar, it's a refurbishment of an old rail that extends eastward from Lobito which is a port town on the coast of Angola, both towards Zambia and towards the Katanga province of Congo. And those regions are rich in copper, which is there's some statistic that I'm not going to remember, but I think to achieve the energy needs that we have going forward, we're going to need more copper than has ever been mined. And so that's to the benefit of a country like Congo, like Zambia, like Chile, like some other countries. I mentioned before that we had allowed ourselves, the U.S. had allowed itself to end up in a strategic disadvantage with respect to China, but also to other countries, that for strategic reasons or maybe in part due to happenstance, but had become a real chokehold or a choke point for the refining, not just of copper, but other critical minerals and rare earths. And I think, you would know this given your own military background, but the amount of rare earths that go into submarines and J-35s and F-35s and other aircraft and technology is huge. And it's as much a vulnerability as say oil coming out of the Straits of Hormuz.
Yeah.
And so the fact that we're taking a real effort that we're undertaking a real effort to diversify supply chains, to find other suppliers, to start taking equity stakes in those supply chains, makes a ton of sense to me. So that's why I'm an admirer of the Lobito corridor. Another factor that I admire is that This goes back to the amplification properties that we discussed before. Yes, the U.S. government is directly involved through the DFC, but the European Investment Bank, I believe, is involved. The African Development Bank is involved. I think that the contractor for the refurbishment is a Portuguese company. I think the bridge building is done by an American company, or at least some of it. So there are other actors from friendly and allied countries that are part of this, and I think that's an example of how a certain amount of American taxpayer dollars has harnessed a much larger amount of other people's financing. And so when we announced that visit, I had been hopeful that we'd be able to find other projects across the continent, ideally involving Kenya. And at the time, the bandwidth was just completely absorbed on the U.S. side by this one single project.
Was it?
And so my personal view is we should be doing 10 of these things.
Right.
And to its credit, what you've seen the DFC do is you've started to see similarly ambitious projects in Ukraine, in Congo, in other parts of the world. So you're starting to see that firepower is now, that newfound firepower is now being deployed. Again, in a way that's both responsible but also benefits the U.S. and hopefully benefits private sector actors who are going to make a reasonable return.
Let's talk a little bit about the firepower. We were talking about the Belts and Road investments, the curves over time, how much relative to what we're doing now.
Yeah.
Can you describe the two and
Sure.
how they differ?
Yeah, I think the headline figure for how much has been dispersed under the Belt and Road Initiative is pushing $1 trillion. And it peaked in, I think, 2015 or 16. And then it declined. And I think that at its peak, those volumes exceeded volumes dispersed by some or perhaps even all of the international financial institutions together. But then there was a decline. And so now what you're seeing for many countries in Africa and I assume beyond is net financial flows, net negative financial flows, meaning that the amount that's going back to China in the form of principal repayments, interest, dividends, insofar it's an equity investment, now exceeds the amount that is flowing from China to those same countries. And so if you are a central bank governor, if you're a minister of finance, this was many of these transactions are between consenting adults. They can read the terms. The terms of these transactions, some of them have been made public, and they are 10-year transactions with a 4-year grace period and a repayment. It's very clear. But there might have been an expectation or a hope on the part of the recipient countries that the volumes would continue at the rate at which they had been coming. And I think those hopes have not come to pass. So you've seen net financial flows, which have negative financial flows, which have really crimped the finances of a number of major recipient countries, while at the same time, financial flows from the development finance institutions where we are a shareholder have been fairly steady, meaning that as a sovereign borrower, your expectation that the financial flows from those institutions would continue as they had, those expectations have borne out. That's a big difference. And I would hope I'm not that close to the DFC, but I would hope that they're looking at sustainability as well as they're engaging with countries, because what you would not want to do is to put partner countries in a position where they're facing what is akin to a sudden stop in external financing.
But you could have cases where, as the Chinese invest less, the large institutional investors will step in and assume those debts, right? That's the only way, right? How else will they repay these? Yeah,
it's an interesting dilemma in the international financial space is if a country finds itself unable to repay Chinese debt, let's say it's a partner country. I don't want to name names, but let's say it's a country that the U.S. has a good relationship with, but has also accepted investment from China. Let's say that they, were maybe that those expectations were not met. That the financing would continue to flow, and they find themselves with more repayments than they have money coming in. It would often be the role of, say, the IMF to assist a country that's facing what's called a balance of payments crisis, right? Where you have more dollars leaving than you have coming in. And so a dilemma that not just the U.S., but any shareholder of the IMF is going to face is, wait a second, did we contribute taxpayer dollars into the IMF to repay loans, sovereign loans from China that are often more expensive than World Bank lending? I should have mentioned that earlier, right? It's not extortive necessarily, but it's more expensive. Was that the purpose of the IMF? Is it really to repay the overextension of credit by China? And there's a certain, I think in like common discussion, if you borrow money that you can't afford, your reputation diminishes, right? But as a creditor, if I know that you have a gambling problem and I lend you money, I'm at fault as a creditor, right? And so there is such a thing as irresponsible lending practices. And I don't want to accuse China of that because I don't know every detail. But it's unclear to me. It's a real dilemma whether an international organization, international financial institution like the IMF should be rewarding lending practices that might have been overambitious. And I'll just be, to be very candid, you can make that argument about the holders like hedge funds and private banks that are also buying debt from countries whose debt might not be all that sustainable. Yeah, so it isn't my aim to attack China purely. I think that there are a lot of creditors out there who are on the border of being irresponsible.
It's notwithstanding even whether that underlying original investment could produce the payback to sustain the original loan if it was subject to corruption and kickbacks on the original loan and it's put on the local taxpayer. So you not only have the problem you're describing, but now there's a secondary problem that how would you finance anything that's not going to produce?
Yeah. I should say, look, debt is a great thing.
Is it?
Yeah.
Okay.
If it's used responsibly, right? Like let's say you've done the math and you've determined that you're going to generate enough returns from the investment, right? And like there are two ways to think about this. One is, let's look at the SGR in Kenya, the standard gauge railway, which has been controversial for maybe a decade now when it was first kind of launched. You have two questions to ask. Number one, can the fees, like the freight fees, can all the tickets being charged, can that repay the debt by itself? And the answer might be no. Okay, but look, like Amtrak, like the railway in Germany, railways are often not profitable, right?
Yes.
But the fact that they function generates all kinds of other business, right? That might not otherwise have existed, right? So in the case of Kenya, let's say you have a trucking company or shipping company, it's able to move its goods from Mombasa to Kenya to Nairobi in a efficient way, in a cheap and efficient way that they might not otherwise have been able to do. Well, now they're hiring people who are paying taxes. They're generating business in Nairobi. So you have these knock-on effects that are much harder to analyze beyond the strict ability of that investment to be able to repay, right? So when you make an investment, like when you borrow the money to invest in a project, you look both at the at the project math itself, but you also look at this broader picture, which again is harder to do. Um, but if you can find that there are positive economics to the overall package, then the debt was a wise thing to contract.
Is there a first mover advantage in terms of like a Belts and Roads or other investment strategy if you know the international institutional investors will cover those debts on the second round?
Um,
So is that what we're saying? Because there's all these secondary effects. You can extract higher rates on the first investment, and then when it doesn't, it falters, or there's ancillary ways you have to get payback like you're describing.
yeah.
Well, then other people are going to carry it, whether it's the taxpayer or the. So there might be that might be the reason we should admire what the Chinese are doing, because they're going to get their cherry before anybody else.
Yeah. Yeah, I mean that's not the reason that I
Okay.
like. That's not the reason that I admire it. Is not because of that, borderline predatory kind of approach. I'm not sure if that was even something that they
I doubt it.
had
Yeah.
planned
Sure.
for.
Sure.
There's been a lot of discussion in the U.S. about debt trap diplomacy,
Yes.
and I'm not a real subscriber to that. I think
It's evolved, right? That whole concept we've really changed over the years, right? It's
well,
better.
it's oscillated, I would say,
Oh.
because you do
Oh.
sometimes hear the narrative.
Oh.
And I would say, look, I have a mortgage. The bank doesn't actually want to take over my house. It's not their business. They don't. That's a nuisance for them,
Yes.
right? They want me to repay them, and they want to move on, and I want to repay them, and I want to move on.
Yes.
But if things fall apart, they're able to claim the house, right? That's not debt trap diplomacy. That's just a mortgage. And so there's asset-backed lending all over in the United States. I mean, in
Yes,
every, probably every country. And I think the most famous case is in Sri Lanka with Hambantota Port. Do I think the Chinese really want to run this port? Like,
Right.
I don't know.
Absolutely.
So
not.
I have mixed feelings about that. About that allegation. It might just be smart lending. If there was not recourse in certain circumstances, then the borrower would just have to pay a higher interest rate,
Yeah.
and that has downsides as well. So, I'm not a pure apologist for the Belt and Road Initiative. I think there's certainly downsides, and like one of them is the inconsistency in the flow of capital. But I'm not sure whether I don't think that there was necessarily a entrapment plan
Yes.
from the start.
Yeah, I can understand that. I mean, so a lot of the listeners are traditional American firms that work in these environments all over the world.
Mm-hmm.
Is there any advice for us as you see more investment from the U.S.?
Mm-hmm.
Anything about a U.S. firm? Because I know you're investing in African firms,
Right.
but what role would be U.S. firms, you think?
Look, I mean, I think the American Chamber of Commerce in Kenya has proven to be very strong and effective. And I think that's in part because of its current and past leadership, and also its membership.
Yeah.
And also, look, the embassy. I mean, I was not a direct, I was a tangential actor. You had other people at the embassy who were deeply involved in AmCham, and I think they also contributed to that level of success. But I think it's the role of any company operating in a foreign country to to a certain extent to partner with your competitors in that environment to
Yeah.
ensure that you all benefit from a playing field which is level and fair, and regulations that are smooth,
Yeah.
et cetera. Going back to my experience at the embassy, I actually witnessed the power of effective lobbying. And as I mentioned to you before, under the leadership of our ambassador at the time, we at the embassy, but while consulting with the private sector, not just the American private sector, but the local private sector, came up with those reforms that we felt that the government should undertake. And I think the real unlock it wasn't just diplomats and bureaucrats telling the government of Kenya what we thought they should
Yeah.
consider. We actually enlisted some American companies, some startups, some Kenyan companies to make the argument, because we felt like that's going to be way more effective Like if someone can actually say, I could create more jobs if
Yes.
this, I could hire if that, I could expand if you undertake this, that's much more powerful than us doing it. Um, and
That's a good point.
and so I think American companies, and I'm sure this is happening, but American companies operating abroad should certainly partner with the American Chamber of Commerce, with the American Embassy, as I mentioned to you before, if they are operating in partnership with not just the DFC, but with any international financial institution. The representatives of those organizations in the country are going to have a seat at the table, are going to have access to, to some of the highest levels of the local government to argue and
Yeah.
make the case in support of those companies when they face a challenge.
So, talking about Africa, how do you think it contrasts with the Middle East in terms of your whole
Yeah,
business space?
yeah. Um, well, I'm certainly more familiar with Africa than the Middle East. I think there's some analogies to be drawn, but I think you can also overdraw them. So I think, for example, I think there are similarities between, say, Pakistan and Kenya. There are also similarities between Pakistan and Egypt, given the role of the security services in the economy, the military. Um, I think there's similarities, for example, if you consider Turkey to be part of the broader Middle East, I think there are similarities between Turkey and South Africa, for example, in their level of sophistication and the strength of their businesses. Um, and then looking at the other end of the spectrum, I think there are Afghanistan, Yemen, Somalia, other countries in Africa. You have countries that are in a similar facing similar governance challenges. What you don't have in Africa are Saudi Arabia, a Kuwait, a Qatar, a UAE, which are deep-pocketed economies that are that are largely fueled by by hydrocarbons. Although all of those countries I named are also actively trying to diversify. So there are similarities and there are differences, and I also think that the relationship between these two parts of the world are long-standing. One historical artifact that I find endlessly interesting is that the Omani Empire shifted their seat of power to Zanzibar for a period of time. And you still have, I think, probably getting older, but you still have Swahili speakers in pockets of Oman.
No, I didn't know that.
Yeah. You have a lot of African citizens are living and working in the Gulf, so it's a significant source of remittances to Africa. A lot of the purchase of fuel that African countries make come from either directly or indirectly from the Gulf region. This is now I'm already hinting at some of the geopolitical risks that we can talk about later. But
yes.
But the history of trade across the Indian Ocean is thousands of years old. And so, we can draw a distinction between Africa and the Middle East, but if you were living on the coast of Somalia or Kenya or Yemen or Persia, you had this kind of coastline continuum, historically speaking. So, now I'm delving into sort of historical artifacts, but I think the interest of there's been a lot of talk of middle powers recently.
Yes.
That's not actually a new phenomenon. Maybe it's a new labeling, but it's not a new phenomenon. And I think like just the rise of the BRICS alone shows that the middle powers have been a thing for a long time.
Yeah.
And I would argue at the time that it was established, China was certainly a rising power, but maybe a middle power at the time that it created that, or that it sort of led that structure.
Yes.
But the Emirates have been investing in Africa for a long period of time. They have food security challenges that they're trying to address. They have regional security challenges that they have interest in shaping. The Saudis have been investing in renewable energy across the continent and beyond for a long time. The EBRD, when I was there, we were certainly co-investors in some of those investments, or I should say partners. So yeah, there's been a long history of trade. Putting my old Treasury hat on. There's been illicit flows as well. I mean, a lot of the opium that was coming out of Afghanistan would come from the Makran coast and end up in East Africa, potentially be transshipped onto Europe. So there are reasons for, I mean, this is not the primary focus of the conversation,
Sure.
but there are reasons for law enforcement collaboration and intelligence sharing, and so these are this is a region that they've been bound together for as long as Pangea has not been a single mass of land, and I think that hasn't changed.
Well, okay, so you talked about geopolitical shocks, and I think you talked about how things, even the magnitude of those things in Africa is even greater. The variance is even greater.
Yeah.
Do you see that as it's still an issue, and do you see changes in the future? Where do you see it all going?
Yeah. Well, I think the only certainty is uncertainty. I mean, that's a cliche, but I think it's right. There will be some other shock. You just look back in the last 7 years, you've had COVID, huge shock. Russia, Ukraine, huge shock. Iran war, huge shock. There's going to be something else. I don't know what it is. I mean, I'm not trying to be a doomer, but there'll be something. And each shock has an impact and also teaches you a lesson.
Yeah.
And I arrived in Kenya the same week that Russia invaded Ukraine. So that was mid-February of 2022. And the shock was enormous. The impact, I should say, was enormous. And now we're living through the war with Iran. If you had asked me in January, if you had told me that the U.S. and Iran were going to be in a no-kidding shooting war in a month, my predictions for the impact on Africa would have been far worse than I think what you've seen.
Yeah, that's true.
Now, what's interesting about this, actually, this is a discussion that I was having with some bankers just yesterday. I think the real-world impact of Russia's invasion of Ukraine is actually far less on Africa than the Iran war. And what I mean is that yes, there were exports of edible oils, of wheat from the Black Sea. Okay, but at the time, just given the time of year, certainly in the case of Kenya, but I think it's true for other countries, the vast bulk of wheat was actually coming from Argentina and from Australia.
Right.
So there was kind of a luck factor there. And at least in the case of East Africa, a lot of tea gets exported to Russia and to Ukraine. So you had a disruption in that buying market. But the real economic impact was actually, I think, limited. The impact was more, and this goes back to that Africa penalty that I talked about before. Borrowing rates by African countries spiked beyond the threshold of affordability. So Kenya could have borrowed in dollars immediately before that war at 6 or 7%. And for the next year and a half, that same rate for, say, a 10-year loan on the international market at commercial rates was 12, 13, 14, sometimes as high as 17%. Through no action by Kenya. They had done nothing wrong. They were in a vulnerable position, but obviously Russia, Ukraine had nothing to do with Kenya. And other African countries at a similar rating, say single B from S&P or Moody's, faced a similar challenge. And that became an acute problem for a number of countries because they had maturities coming due. And in the case of Kenya, where I'm more familiar, they had a $2 billion bond due in June of 2024. And it started to put pressure on the currency.
Yeah.
You had fuel shortages because the ability of the country to even find dollars, to borrow the dollars necessary to make fuel purchases was impacted. But again, like the real world impact, if I can put air quotes on that phrase, was actually not significant. It was the financial impact, it was the reputation, or it was the global sentiment had a real negative impact on Africa, on Kenya, and a number of African countries. But they learned a lesson, and so Kenya has been able to push back a lot of maturities to 2028, 2029, which I think it was expensive, but I think it was a smart thing to do. And then they also built up foreign exchange reserves from, say, mid to high single digit to low double digit, say 12, 13, $14 billion. And a lot of other African countries have pursued a similar insurance mechanism. So then the Iran war starts. My impression would have been a far bigger impact than what you saw with Russia-Ukraine.
Yeah.
I think the real world impact is more significant because as I mentioned before, you've got African workers living in the Gulf region whose jobs are now at risk, or who might have returned home out of safety, or there might be disruptions to flows. Those same countries that have in the past made a lot of investment into Africa, and I'm thinking of Turkey, Saudi Arabia, the Emirates, Qatar. You might imagine they would pause some of their investments because now they have domestic rebuilding to do and other other distractions. The price of oil. I mean, in the case of Kenya, they import, depending on the price of oil, $4 billion of oil a year, which is again 4% of GDP. It's a significant number. So when the price goes up by 30%, it's significant. I mean, from my own house, you could hear protests and tear gas canisters a couple of months ago when people were protesting against those fuel price changes.
You weren't in those protests, right?
I was not.
Okay,
I was sheltering in place.
Okay.
But I understood the sentiment.
Sure.
Right. So the real world impact, I think, is much more significant. But the African countries have made themselves actually much safer. So again, like, they learned a lesson. Now they're going to learn some new lesson. It'll be hard for me to predict what that is. And whether that lesson will be applicable for the next shock is something we'll have to find out.
Could be more electric bikes. I don't know. Going back to your
no, that's a wonderful question. I mean, now you're just throwing me a softball. I mean, I think every country in the world. I mean, Europe was learning this with their reliance on natural gas from Russia, and I think countries that are now reliant on crude oil anywhere in the world, because even if you're not buying it directly from through the Straits of Hormuz, you're still exposed to price shocks. And if you're buying like an electric motorcycle, I'm not talking about a bicycle with a battery pack, but like a motorcycle that's powered by an actual battery. And these batteries are like twice the size of a typical car battery. The upfront cost of that bike is probably higher than a typical internal combustion engine bike. But over the lifetime of that bike, it's much cheaper. And I don't have those figures in my head, but the amount that you're going to pay for every kilometer you drive, if you're using a battery, is far less than if you were using petroleum. And that goes back to the point I made before about affordability, right? If you can't afford that bike up front, you're going to have an old-fashioned combustion engine bike, and you're going to pay more in the long run.
Yes.
But if you can overcome that affordability challenge, buy the bike, which in the long run is cheaper, you're better off. So I think you're going to see. I mean, it is possible that the Iran war is going to drive a green transition, or is going to accelerate a green transition faster than had been the case.
Well, John, that concludes our discussion. Do you have anything you want to bring up or discuss before we close?
I'll just express gratitude for the invitation. As I said to you before we started, this is the first podcast I've done, and I couldn't imagine a more friendly environment. So thank you for the opportunity.
Yeah, thanks, John. And we really wish you luck with Renew Capital. We really want to see better investments in Africa. It's in everyone's interests, and you guys are on the cutting edge. So thank you.
Our aim is to stay there. Well, thank you again.
Okay. Thank you for joining